Hello, today is Friday, the 19th of December, 2008. This is Brian Shannon from alphatrends.net, and the market's closed here for the week. The NASDAQ finished with a gain of 20 cents today, or 0.67%. It's really kind of a quiet trading day. Here we had options expiration, of course. If we take a look at the 30-minute time frame, the trend line that we've been observing remains intact. It was tested on the open here and late yesterday as well. There at 29.5, and that's the level that I said it was going to need to hold on a closing basis. This level also held, so for now this remains pretty important near 29.65. Just below that is 29.50. It really appears the market is just turning more range bound than anything. When we look at a hourly time frame, we've still got that resistance up here from the two-thirds retracement of the election high to the recent lows. So that 0.618%, 61.8% retracement of this move here is significant. We keep hammering away at it. The resistance hasn't given way yet, and we're either trapping in longs who are going to spit them out as the market breaks down, or we're building energy for a break back to the upside. The primary trend remains lower. It's really tricky in here. It's tough to say which way it's going to go, and I think you just have to remain very flexible in this environment. And it's continues to be in my mind a day trading environment. I've been just day trading. Haven't really taken anything home overnight. So risks are still to the downside. I think again, breaking a trend line doesn't automatically mean that we're going to reverse lower, but you've got to keep an eye on these levels below as well for potential support. That if this 29.5 gives way on a break of this trend line early next week, I think you'll get a quick knee-jerk sell-off that'll be a nice trade, and perhaps it settles in near this 28.75 area or so. Overall, the 10-day is above the 20. They're both rising. We've got a declining 50-day moving average. A lot of indecision here on this daily time frame, and this level remains important as well. Obviously, down near about $29 a share. So, just a lot of reasons to think that you've got to just take it slow in here and let the opportunities present themselves to you. I've been trading a lot more of these leveraged ETFs lately, in particular the triple levered funds, on the Russell 2000 and on the XLF. The Russell 2000 has been stronger than the other markets. If we take a look at the daily time frame, we're obviously still in a downtrend. We've got a declining 50-day moving average. We came up to that 50 level today and touched almost exactly on that 50 area before the sellers came in here. You can see that on the 1 minute time frame. But we've still, we've got this little uptrend line that it came down to right at the end of the day. We are above a rising 5-day moving average. We have a lower high and a lower low here. So again, mixed messages from the various time frames. I think the more relevant trend lines for this market are probably right here like this, and then again, that trend line. So I think that the more important levels of support right now are basically right in this area from 47 to 47.5 or so. Breaking below that probably leads us down towards this level. And on the Russell 2000, the long fund is the TNA. This gives you triple the percentage move, and then TZA gives you triple the bearish move in the Russell 2000. So something to keep an eye on. I don't really trade the IWM so much. It's gotten really boring with all these double and triple levered funds, but risks remain skewed to the downside with this primary bear market. You can't get complacent with your long side trades. They should be just trades in this environment. Oil is a great example of why it's so dangerous to try and pick the bottom. And look at the weekly time frame. Each week, we've seen this massive increasing volume, and when we're down at new closing lows on the week in here. So I had pointed out a couple weeks ago that this large volume, a lot of people say, well, the big volume peaks at turning points, and that's generally true. But you never know until after the fact what that turning point is, because the next day or the next week could be even heavier volume, and that's what we're seeing here. So on the 30-minute time frame, we remain below this low here. getting back above that. Maybe this market starts to stabilize, but there's just no signs of a bottom in oil, and there's very few people who've been able to claim that they picked the bottom. The only people that have picked the bottom live below this level here. So basically, over the last day and a half, maybe you've picked the bottom so far, but there's nothing here to suggest that bottom is anything more than just a temporary little low. That's all you can look at it for now. The financials. This market, holding above this little trend line here, kind of coiling in this little, triangle formation, lower highs, higher lows. They typically resolve themselves in the direction of the primary trend, which obviously is lower for the financials. You just look at these things, and it's human nature to look at it and say, it's down too much, it can't go any lower. But again, look at oil. That's what people have been saying the whole way down. That's what people have been saying all year on the financials as well. This market here, we've got what looks to be an important trend line on this. And you can even actually look at this as a head and shoulders pattern here, left shoulder, head, right shoulder. And, if you look at some of the technical analysis books that talk about patterns, they don't all have to be nice and straight up and down. That is, the neckline doesn't have to be straight across. You can have a ascending neckline like we have here, in which case 14 down to 11. I mean, that would give us a bearish projection. And again, I want to discount all these patterns. I point them out when I see them, but they're not really something you want to trade on. Trade on price action, not a pattern, and price action from these shorter term timeframes. But if it were to reach this, objective, it would bring us back down towards that $9 level, and that would scare, quite a bit of people to get it back down to those lows. A lot of tax loss selling. It's certainly a possibility. Maybe there's some of these hedge funds that are still unwinding and closing down before the end of the year, which continues to put pressure and just leave a lot of risk in this market. Right now we've got that $12 level is it's got a little bit further significance because it was this level of resistance here, and now has the potential to be support along that trend line. So the financials, again, it's kind of disappointing that they were unable to close above this $13 level that has been important. We saw last week a couple days above it. We still got that declining 50-day moving average. Rallies are guilty till proven innocent. They should be nothing more than just your very short-term trades. The semiconductors rejected, this week at a declining 50-day moving average. They got above it for a couple days, and it's the direction of the 50-day moving average that's more important than where the market is in relation to it. Rallies, above the 50-day moving average, while that 50-day moving average is declining, typically will fail. And I have been pointing out, as you know, the Chinese market. Now, this one's not doing what typically will happen. Instead, it's finding some support in here. So you have to just look at price action, and only price pays. You have to look at the shorter term time frames. Obviously, that $17 level has been an important one. We've had this trend line break this week. We also have a lower high. We're back below the 5-day moving average. I think this level, as far as $18, that's where your important short-term resistance lies. Getting back above there, maybe we do battle with this 50-day moving average again. But for now, we've got a lower high, and I think breaking back below that 17, then you could see a pretty sharp move back to the downside in the semiconductors. The S&P 500 was down $1.10 or 1.23% today. Closed below the 50-day moving average on the week. If we look at the 30-minute time frame, you see here that this is the most relevant trend line. It was broken. We also saw this little level break in here late in the day. So risks remain to the downside. The bigger level of resistance obviously has been right in here at about this 92.30 or so level, and we've got a broken trend line. We've got a primary downtrend. Risks are to the downside in all these markets. So just continue to trade, very aggressively in terms of your, how long you're holding in here, and that StockTwits is a great place to find ideas.